All right, let's give them a round of applause. Welcome. It's not easy coming to like a meetup on the first time, especially right in the middle of the Orioles game. What's the score of the game?
0-2, I think.
Still 0-2? As in, they're winning? They're still winning?
0-2, still winning.
And the relievers are in?
Against the Brewers.
Yeah, well, no, they're actually pretty good. Wow, impressive. Yeah, thanks for coming. I know that it was not expected to have opening day at home on top of our Maryland Investor Network meetup. Damn it. But I'm glad you guys are here and excited to have Jack speak. So for those of you who don't know, we have restrooms on every level of this building. So right out here, right by the elevators, you got restrooms. If you also need some water, there's a little fountain there, and then like a soda machine. We will run this for about hour and 15 of Q&A, and then between Jack and I, and then we'll get to your Q&A, and we'll do some networking, and then probably kick everybody out around 8. Sound good? Show of hands, how many of you flip houses? Or have flipped at least one purposefully? All right. How about rentals? Who dabbles? Nick Alphas, you dabble? A little bit. All right. How about real estate sales, realtors? Who's here at realtors? All right. Wholesalers. Who has done at least one wholesale deal? All right. How about construction? Anybody here in construction? Aaron, you're not in construction? All right. You guys might remember Aaron from last month. He's my contractor. How about, what am I missing? Lending. I'm missing lending. Yeah. You raise your hand for everyone?
I've done it all.
Yeah.
Name some I haven't done.
So Jack here, he'll speak a little bit about all of them today. We'll intertwine them, but he also has done them all. So without further ado, I'm going to go ahead and scoot back so you just see Jack and bring him in. So Jack is a friend of mine. He's somebody that I've looked up to for a long time. A mentor, just an all-around down-to-earth guy. Who's heard of Dominion before? Yeah. All right. So Jack will get into that story. He is somebody you definitely want to know. So at the end of this, make sure you get some airtime with him one-on-one. So Jack, welcome. Thanks for coming.
Yeah, no, thanks for having me. Appreciate it.
My collar keeps hitting the mic, so forgive me. All right. Why don't you start with a little bit about your background? Where did you grow up?
Yeah, sure. So I grew up in Edgewater, Davidsonville, went to South River High School, and born in Anne Arundel County, grew up here. And then went to school in Philadelphia, and then went to work in New York for a couple of years. I actually interned at Dominion when I was in college for a summer. That's how I got to know my now partner, Fred Lewis. He started Dominion in 2002, and I interned for him in 2004 for a summer, and just thought it was fun, going through houses and basements, and gave me kind of, at the time I think there was like 4 or 5 people at the company, and so just kind of got a very hands-on internship, enjoyed the experience, and so in 2006 he ended up, I called him for a reference because I was changing jobs, and he was the only guy I could use other than my current employer, and he, instead of giving me a reference, he ended up talking me into coming down and working for him to do acquisitions. So it's like summer of 2006. He's like, yeah, I just need, more horsepower, basically. And so I came down. I just thought it'd be fun to buy houses. And I was 23, and didn't have a whole lot to lose, frankly. If I figured if it would be fun, if it worked out, great. If it didn't, I'd go back to New York. So I ended up starting in March of 2007 in Baltimore, and then the market that was basically the day when I showed up, I unpacked, and then the market just started to fall off. And so I just saw nothing but a down market for like the next, 3-4 years. So that ended up being a fantastic, incredibly fantastic learning experience. the company had been built well, wasn't over leveraged, and didn't have any systems or processes really to speak of. It was kind of like a one-man show with some people helping them out. But we, over the course of the years, kind of tried to turn that into a company and with systems and processes, and so we just built the platform kind of over the years since then. So we were fortunate to make it through the downturn, though we basically worked really, really, really hard for 4 years to make it through. But then there were lots of opportunities, having made it through, to kind of build on from there. So yeah, that's how I got started.
Let's rewind. What was Fred's business like when you got started? And then let's compare it to where you guys are today, and then we'll fill in the gap.
Yeah, and I'd say if he was sitting right here, it was basically the Fred Lewis show. He worked. If you haven't met Freddie, he works like a dog. He's about 15 years older than me, and just consummate entrepreneur, and had done through brute force. Was doing a lot of deals. Had built up a nice sized rental portfolio of houses that hadn't really been renovated, but we didn't really know that at the time. That's something that we later came to learn. But everything went through him. So it's just people would the acquisitions, everything would come through him. Everything, property management, leasing. He signed every check, managed every contract. Everything was routed in and out of him. So was doing a lot of business. Out of purely brute force. At the time he was in his 40s, so he could keep that up for a little while, but can't keep that up forever. And so it was it was a very slow. I would say it was a slow process because I was 23. I had no experience, didn't actually know what I was doing. We kind of just I learned acquisitions and property management and construction. Learned the lending business along the way throughout all that, and so we just kind of made tweaks to each of those platforms as we went. But it has always been an exercise in kind of building the train as it's going down the tracks. Not many have the luxury of writing down a business plan and then raising money and then putting all the pieces in place and being like, all right, we're going to start business tomorrow. Like, that's just not how the real world works. We've gone through lots of different phases of business as we've grown. We've gotten to there's been a number of times we've gotten to inflection points where like the system, the machine that we built to get us here will not take us any further, and we need to break it all down and rebuild it in a new image. But but you have to keep the lights on the whole time. Those kind of like inflection points, I think, have been kind of the most challenging and but also like most fun parts of it.
What's your landscape look like right now? What are your different arms or companies? What do you guys have?
Sure. Hey, if I take this off and just talk loud, is it okay? Or is it the Facebook thing?
No, let's try it.
I'm kind of loud. Can you guys hear me?
Yeah.
All right, cool. Just the feedback is kind of so we have so right now Dominion has so it's three main we have Dominion Management, which is a property management company. We manage 850 rentals. 750 of those we own in our different rental holding entities, just made up an LLC that owns a bunch of properties. So we have 750 rentals that we own and manage. Acquisitions and construction management, everything's vertically integrated. So acquisitions, construction management is all in-house. And we buy about 100 houses a year, renovate about 75 of those. Do a mix of single family fix and flip, wholesaling, and we're doing some infill new construction right now just because it's been really hard to find deals that make sense, that have margin in them, unless they were like really heavy lifts. So we've been doing more infill new construction and like large like heavy rehab projects. We're doing a 45 unit multifamily project right now on the west side of downtown. It's the first time we've ever done something like that. pray for me. And so that's kind of Dominion Management and Dominion Properties, and that's about 50 employees. And then our lending company, we do basically acquisition and renovation loans, like fix and flip loans, to real estate investors all over the country, everywhere except for Nevada. And then also we have a 30-year rental loan, like DSCR loans, basically, kind of designed for landlords who are building their rental portfolios and don't want to deal with their local bank. And we lend that nationally as well. And that's we're up to about 100 million a month between those two lending products. And that's about 95 people right now, which is a huge increase. The lending company is a huge increase over where it was 2 years ago, driven mostly by that 30-year rental loan. That landlord loan has been, I think, for the industry, a game changer, certainly for us.
Who here has purchased a property from Dominion or have maybe gotten a loan from Dominion?
Something.
So,
Thanks.
thank you. So as you can see, they got a lot of different things going on. What does your day-to-day look like among all this?
Yes.
What do you do all day?
Yeah, so it's changed a lot over the years. Now it's really management, kind of people management, which I, bemoan a little bit because I kind of fell in love with driving around the city and breaking into houses and underwriting stuff at the courthouse steps.
How long did you do that? That kind of stuff?
Well, I did that until 2 years ago.
Really?
Yeah.
That long?
Yeah, I did. That's all I did for the first 5 years. And then I really only let go and let our acquisitions manager take things over maybe 3 years ago. So now it's mostly managing people, analyzing the reporting to see where stuff's breaking, and trying to get in front of it and tweak systems and processes, identify if we have the right people in the right chairs. Is it a people issue? Is it a process issue? Is it just shit happens? And then try to look ahead to plan for, what the next opportunity is, or how, the world throwing curveballs at us, which this year has been the theme, is going to affect the businesses.
Let's get into that. Right now, what when you say curveballs, what said curveballs are you seeing thrown at you?
Yeah, sure. So the biggest curveball. Huh?
I want to yell, but I don't want to yell at you. So I think I gotta space out a little bit.
Sorry. So the biggest curveball, most recently has been the interest rate increases. In December, I remember talking at a mastermind, and I was talking to the room and saying hey, Freddie Mac's economists and the Mortgage Bankers Association economists think that mortgage rates are going to go up 100 basis points over the course of the next year. That's going to be that could have a really significant impact on our business. And 75 days later, we were there, and it's gone further than that. And so while we haven't, it's frankly remarkable that we have not, with as much of an increase in consumer residential mortgage rates, that we have not seen a whole lot on the street of softening yet, which is kind of, I don't know, I think a little terrifying.
And you're referring to prices.
Yeah, prices.
Street, yeah.
Not even terms, right? It's not even, we're still not even getting home inspection, we're still getting no home inspection contingency. We're not even in a normal terms market, which freaks me out, frankly, because that's just, that shouldn't sustain for a long period of time. But that's still the case because, the other curve is supply, and that is still ridiculously constrained. That curve has been moving at the same time. So, we're still so undersupplied. If the supply curve moves at all, I think that we can have a very quick and aggressive, violent adjustment, given that we've got so much so much interest rate, so much affordability loss, but we've not yet seen that in prices yet. If supply does increase, I think we could see quick movements to terms and then pricing.
So we're going to get into some predictions of rentals, interest rates, flipping, wholesaling, how Jack is going to be, how he might be changing his business models in those arenas or not. But before we get into those predictions, have you ever been wrong with a prediction before?
I'm always wrong with predictions. I thought when COVID hit, I told my acquisitions team to bail on every contract. We sub-purchased out of everything. We walked on anything was a grand or less deposits. And like 45 days later, I regretted that decision, tremendously. So yeah, I've been often wrong.
All right, so let's get into it. What better segue?
Yeah.
All right, so starting with your, let's go macroeconomic, and then we'll go into like different types of.
Oh, can I hit on one more thing before you do that?
Absolutely.
So the other impact to interest rates has been also felt on the investor side through these DSCR loans, debt service coverage ratio loans. It's just the industry term for them, and those loans are made by companies like ours, but also like 30 other companies across the country, and then they're sold to a dozen. It's really only a dozen note buyers, like pension funds, insurance companies, mortgage REITs that buy those loans, and that they either keep them on their own balance sheets and just clip the coupons, or they do a securitization. And they issue bonds as a source of their own financing. It's basically like them going to the bank to finance the loans that they bought. And so those bonds, when those bonds are sold, the people who are buying those bonds think that they're going to pay off in 5 years. They think the loans are going to pay off an average of 5 years, because that's what it's been historically. So when they go to price those bonds, they price it off of the 5-year treasury. So if you want to watch what's going on with DSCR rates, just keep track of the 5-year treasury curve, because that's the index that these are trading off of. And over the course of the past 120 days, the 5-year has moved like 175 basis points in that short of a period of time, which is just like unprecedented. Like if you look at the historical curve, like that's just, it's a spike. It's like a huge spike, which has frankly been rough. Like it sucked, because we haven't seen that in investor pricing, right? Like we're landlords. This isn't emotional. We're doing this for a buck. So if all of a sudden our cost of capital has gone up, but the house costs the same and the return we're getting from the house costs the same, that just means that our margin is getting squeezed. And when you're buying houses at a 7 cap, and you're borrowing money at 4.5, 5, like cool, that's fine. That's a business model. But when you're buying houses at a 7 cap, because they're still at a 7 cap, and now borrowing money at 6.5, it's barely accretive financing. It's like hardly worth the energy. It's not worth my argument is not worth the energy. So something's got to give on that front. I think even like more significantly, because there's no emotion to that. Like landlords should be rational economic actors. So either real estate prices for landlord properties have to come down, given supply pressure from flippers and homeowners seems unlikely in the short term. Rents have to go up to compensate so that your cap rate just gets better through rent growth, which while we are seeing increases in income inflation, it's less for particularly like the lower quartile of income earners, like renters. Their incomes are going up 5% in an 8% inflationary environment. So they're actually getting squeezed. They have less discretionary income to pay the rent. But maybe that continues. And so rents continue to grow up there. So that's something that I'm watching very closely. Or interest rates have to come back down. And until inflation's under control, I doubt that that's the case. So I feel like right now we're in this period where interest rates have gone up for landlords, but that hasn't been felt anywhere else that it needs to be felt, or we haven't yet seen that play through the rest of the supply and demand curve for investment properties. So I'm thinking about our own business. I feel kind of skittish right now because I feel like the other shoe hasn't dropped, and it has to. Given how much we've seen interest rates increase so far. So
to break down what you just said, in a nutshell, you're seeing on the rental side, because of the cost of capital going up, the interest rates, like give an example for interest rates, what was your DSCR loans that you were quoting, December 31st to now? What were they and what are they now?
Yeah, they were 4.75. Now they're 6.25, 6.5. Like they were, yeah, anyway. Yeah. So, and by the way, I feel like, and it stings here too, because I'm borrowing that money. So like our cost of capital is someone who's adding rental properties to our own portfolio has gone up 150 basis points in a 90-day period.
And now 2 or 3 years ago, that was still very good money. I mean, 30-year at, no doc, at 6.5. I mean, I was getting stuff at 7.5, 8 for 30-year fixed, no call. And yet though the prices, so we're talking about the shrinkage in margins from the prices. So prices are still, outrageously high. So for those rental purchases that you just bought, and the rates have gone crazy on you, they've gone higher than you originally projected, but you bought at the prices at which the market was. What are you doing to dispose those? How are you refinancing those? Like, what are you going to be doing here?
We're just going to refinance them, but not expect to make much money, off of them. Just stabilize them, live to see another day.
Why not sell them?
We could. I mean, in an inflationary environment, I like owning real estate. Like that has been a good thing for us. And you still get bonus depreciation off of it. So come tax time, rental properties are still advantaged right now. But I think it definitely leads to when you get rid of that gap between what you can collect from the net rent check and what you're paying the bank, when there's not much there, yeah, it's real tempting to sell.
And what you're seeing is rents can't keep up with cost of capital, shrinkage on the rentals side of the business. So are you guys toning, like specifically change your criteria to basically buy less rentals in this time? Your rental business of Dominion, how are you guys changing that based on this?
I think we will end up buying less just because our bids are what they are. And I think that is going to mean that we are going to buy less.
What are you performing for rates when you're bidding right now, not knowing what 90 days is going to look like from rates or cost of capital?
I mean, we're using just today's rates, whatever today's rates are. Yeah, like I don't have a view on interest rates are going up or going down. If I did, you can go to Wall Street and make a pure trade on that. Mm-hmm. So like I don't know if they're going up or going down.
So you're not getting ultra conservative, like I think they're headed to the moon, but you are just as of right now.
Yeah,
performing, which is bringing your prices down, and that's inevitably making you buy less.
Yeah, exactly. Yeah, it's just I'm not making like a projection as to what's going to happen. I just know that where they are today, there's no margin, or margins are very skinny.
And when you talk margins, like what are you looking for in your rental margins?
I mean, your lender's looking for at least 1.2 times debt service coverage. That debt service coverage ratio calculation in the industry doesn't factor in normal operating expenses. So if you're really if your lender says you have a 1.2 debt service coverage ratio, I think you're like barely breaking even in like if you're honest about your expense ratio. And I don't sleep very well at night under 1.4, like under 1.4, because there's almost just not a lot of cushion there.
Semi shift here. Thoughts on city versus county right now? When you're for your rental portfolio. What is your current mix, and what are your thoughts on that?
Yeah, so we have 750 rentals, 600 of those are the city, and we own everything from Sandtown to Fells Point. We own all over the place. And we do a lot of analysis on our own rental portfolio to see because your expenses ratio is just, if you have $1 of rent, how much of that $1 of rent goes to paying the expenses? This isn't talking about the bank. Like forget what your loan costs, just property taxes, insurance, repairs and maintenance, turnover, vacancy, capital expenditures, all of the expenses that go into operating a rental property for the long term. Those vary by location. And so when you're in Sandtown, you could have like a 60-65% expense ratio. If you're in Bel Air Edison, it's more like 50. If you're in whatever, if you had a rental in Roland Park, then you'd be 30-35. The county, 695 corridor stuff tends to be like more like 35% expense ratio. little bit higher when you're in like Dundalk or Woodlawn?
Lot to delve deeper here. Quick backstory. Jack, as you can tell, he's very good with numbers. Have you been able to tell that so far? When you're thinking of questions, we'll open up the questions, fire away at him. Very transparent, open book. You can see why we like him and why we have him. And I remember sitting down right in one of these offices here and going through my expense ratio. So basically you're taking all your different expenses, subtracting it from your rent. And Jack goes, "You're missing a big one." And I'm like, "What?" Like, I think I got them all here. And it was turnover. Most of us, how many of us don't, we account for vacancy, yes, property taxes, repairs, insurance. But what about turnover? How many of you are sitting here thinking like, I need to add that as a line item on my pro forma? Why?
No, it's just you.
Yeah, it's just me. It's just me. No, you guys have already, you haven't figured it out, I understand. But let's talk, I want to go a little bit deeper because I want to get to the whole tenancy duration conversation that we had. So can you talk a little bit about that hidden expense that most of us don't calculate for, and why you calculating turnover, how are you calculating it, and get us to the tenancy duration?
Yeah, sure. So when you get an email from a wholesaler and it's a rental property, they'll tell you, "Hey, here's what your property management's going to be. Here's what your property taxes are. Here's what your insurance. Then $50 a month for repairs and maintenance." And so your cap rate is 9%, and that leaves out what I call like kind of below the line expenses, which include that your vacancy rate is that's the number for the fact that it's going to be vacant for a little while and not rent producing. But every time that happens, you have to pay to turn the thing over. So turns in the city are not $1,000; they're just not. And especially if your tenant's been there for any longer period of time, which you'd like to see happen. So I mean, our turnovers are $5,000 turnovers. That's not atypical. And every time the property goes vacant, not only is it vacant for a little while, so you have vacancy loss, but you have to pay for a turnover, and there went $5,000. You also, unless you're paying, we also have to pay to release the property. So you're going to pay a real estate agent or somebody who works for you, or you're going to go spend your time. But if you're spending your time, then you should be allocating to pay for yourself a commission for finding that tenant, doing the tenant screening, and doing the lease signing and all that jazz. And so whether that's half a month's rent, a full month's rent, it's somewhere in there. That's market for that. So you should be reserving for that as well. And so when you allocate money for those things, the denominator in all of those expenses is every time there is a turnover. So if your tenant stays for 2 years on average, every 2 years you're spending money on a turnover, on vacancy, and releasing the property. If they stay 6 years, well, then you're only having those expenses every 6 years. It's much less, right? You have to reserve much, much less each year if they stay 6 years versus 2 years. And I think that is something that is almost never represented in a marketing email from a wholesaler, but is, as when you're the landlord, those are absolutely expenses that are incurred. And so like one of our, and so you do a sensitivity analysis as a landlord. All right, how much money what's my return going to be on my rental property? And you're like, here's all the different things that could happen. And you do a sensitivity analysis and all those things. The one that by far blows all of the expenses out of the water versus the rest is how long is that tenant going to stay? So you get an extra $50 a month in rent, but the tenant stays 3 years instead of 4, you lost. It doesn't matter that you got the extra $50 a month in rent. Like, get them to stay a long time, and as a landlord, you will make money. And in the Baltimore metro area, if you don't have at least 3 years of tenancy duration, I don't believe that you're making money in this business.
And that's probably being conservative, don't you think?
Well, I don't know. Yeah,
because you did a study of your guys' portfolio, right?
Yeah. So one of the first things I did when I started was Fred had built up 175 rental properties, like a nice size rental portfolio. he had bought a lot of them from kind of the older, there were 20 years, 30 years ago, there were a bunch of older landlords that owned lots of properties all over the city. They were full of lead paint. And when the lead paint lawsuits happened and you could no longer get lead paint insurance, they all sold in mass between like 1995 and 2002. Like they just all got out of the business. And they'd go to Alex Cooper auctioneers and they'd go have these gallery auctions and they'd literally just be putting a front picture of the house up and it would be like $850 a month rent. And here's the lease start date. Like, let's start the bidding at $50,000. And they sold thousands and thousands of properties that way. So Fred had picked up about 175 when I started, and they didn't make any money. Like, there was stories to every property, but as a portfolio, we had 175 houses, and they made no money. So Fred was like, "Why is that?" Like, hey, kid who likes Excel spreadsheets. Why is that? And so I just, spent a week or two and dug into all the data. And what we found was that for us at the time, our Section 8 units, which were maybe like 5-10% Section 8 at the time, those made money, which was very counterintuitive, right? Well, for us it was at the time. Those made money, and the rest of the portfolio lost a little bit of money. And it wasn't that maintenance was more, like the maintenance was a little bit higher in the Section 8 ones because they're home all day. More on average. It wasn't the utility bills, it wasn't the leasing timeframes, it wasn't, I was holding for all these variables, location, year renovated, nothing was really the driver, except that the program tenants were staying longer. But it wasn't that they were program tenants, it wasn't that they were Section 8, it was that the Section 8 people were staying for 5 years on average, and our market tenants were staying for 2.5. And so all of the money we made from the market tenants during the course of the lease, we gave back when it went vacant. And we did that every 2.5 years. So we made a bunch of money and then we gave it back on the turnover. And then we made a bunch of money and then we gave it back on the turnover. Whereas the program tenants, they tended to stay a little bit longer. And so we actually got to keep that money because they only left every 4.5 years instead of 2.5 years. So in the middle of the Great Recession, we systematically over the course of 18 months vacated the entire portfolio, re-renovated everything, and then leased it directed towards program tenants on the thesis that they would stay longer. And that bore out. And today we're like 95% program tenants because they stay longer. Like that's the reason that we do that, is because our average tenancy duration is 6.5 years. And that means we can make money as a landlord.
Interesting how it wasn't about area. It was about the type of tenant. So,
but the thing is, it's harder to get someone to nest in Park Heights than it is for them to nest in whatever 21239 Northwood. So
back to county versus city. What are your guys' thoughts right now when you're looking at rentals? They treated equally?
So yeah, we have different because the expense ratios are going to be different. One of the drivers of those expense ratios is tenancy duration. If you rent property to somebody who lives in Pikesville, you have a very good chance of them staying for a long time. So I can bid to buy that house based off of a lower expense ratio in that location. And so we kind of translate to like gross rent multipliers, just because it's easier to do the math in your head than trying to bust out an Excel spreadsheet and do a cap rate every time. So based off of the competitiveness of the location, basically, based on the ARV of the location, a little bit a higher gross rent multiplier in a nicer area and a lower gross rent multiplier in a not so nice area. As a way to adjust for the fact that the expense ratio in those tougher locations is going to be higher. And then you want to also factor in that you want to also get paid more to be in a tougher location because there's more risk. There's going to be you're going to have winners and you're going to have losers, and your losers in the tough locations are going to be worse than your losers in the nicer locations on average. So we adjust for both so it's basically a matrix. We just come up with a matrix of
Right.
here's where the gross rent multiplier needs to be for each of these locations because we want this cap rate and this is the actual real expense ratio.
What about type of dwelling, from the single family to the multis? What have you learned?
I haven't learned. I've learned that they're offsetting variables. So your expenses, your capex is higher on the like a single family detached house, but the tenancy duration is much longer. So they just offset.
Really, you think they?
Yeah. So we love
treat them kind of equally.
Yeah, we love townhouses because the maintenance is low. Townhouses in the county are low maintenance.
Yeah.
Not a lot of exterior work that needs to be done. The location's good, so people stay for a long time. Like I love that stuff.
And what are you shooting for from for margins? Like at the end of the day, after your expense ratio, like breaking it down.
Yeah.
What are you making?
I think that we were in nicer part, like a Rosedale townhouse, like an I-695 corridor kind of like townhouses. When we were being honest about our numbers, we think we were buying those at 6 caps. And that if you were in a tougher location, maybe you could get up to like an 8.5. But I don't see cap rates higher than that.
What is that like about a cash flow, like per door? Like really break down, like
what do you mean?
Your margins per door, like dollar margins. So like pool side cap rates if you can. Like give a ballpark, a range for.
You mean like net cash flow per month kind of thing?
Uh-huh.
I guess it's hard to do that without taking your financing into. You talking about without taking your financing into consideration?
With financing consideration, like out the door, net. Like what do you think you guys are really shooting for net cash flow per door?
My honest answer to that is that I think that's the wrong question, because I think what the right question is, what is the return? What is the real net return I'm getting for this location before I think about financing? And am I been honest about my expenses? And when I say, all right, that's a 7.5% return right there. Is that a good deal? Is 7.5 good for
you're
that
talking
location?
about return on your cash that's left in the deal after the refinance.
Well, I haven't gotten there yet. So 7.5 just on the deal. If I bought the whole thing cash,
Gotcha.
And then when you come to get put financing on it, can you put on? How much of your cash are you going to have stuck in the deal if you still have that 1.4 debt service coverage ratio? If you're being honest about yourself, or an honest 1.2 debt service coverage ratio. And so just put that much debt on it, model that much debt on it so that you have a 1.2 debt service coverage ratio. And then look, all right, what's that mean? Can I get my hard costs out? Can I get my money back on the refi with that much debt, or am I going to have 10 grand stuck in, 30 grand stuck in, 50 grand stuck in, and then decide is this a feasible investment for me, given that everybody is cash constrained, right? I think that's the better way to approach it. I feel like because I think you can get yourself in trouble saying, hey, I'm netting $200 a month on this house, I'm good. That doesn't mean you might be good, but you might just be like a dead man walking, and you don't understand why. And
how could that play out to be the dead man walking?
Just because for example, I'll use an extreme example. Say I was, I got a property I'm picking on Park Heights for some reason. I got a rental property in Park Heights, and I net $200 a month cash flow on it. And I'm feeling I'm good. But the thing is that Park Heights rentals, they're good, they're bad. They're good, they're very good, or they're very bad. And so right now you're very good, but you've not factored in all these reserves that you should, because if you're going to own this property for a long period of time, you're going to have bad years. And the question is that bad year going to is going to put you in foreclosure? And that's what, if you just focus on every house as, if you don't, if you just say hey, I'm net cash flow positive this year, I'm good. You may be
not
just
good.
Putting yourself in a very risky position, and eventually, the world catches up with you, So we have properties that are great, and we have no maintenance, and then we have horror stories, and they happen. You have to that's one of the nice things about building a portfolio is that the other ones can pay for your nightmares, but you have to be realistic about that they're not all going to work out. The pro forma.
Yeah. When you're talking about your pro forma for the program tenants, what are you budgeting for the annual inspections, Section 8 annual inspections?
I think we do $75 per unit per month for repairs and maintenance.
And that includes?
Which is normal repairs and maintenance, like calls plus the annual is that.
Really?
So, yeah,
75 a month?
Grand a year kind of thing.
So when you're doing your expense ratio, pulling out your property taxes, pulling out your insurance, 75 a month for your repairs, and your annual inspections, your repairs, maintenance, annual inspections. What would you say you're budgeting for CapEx? Let's keep with the row home in Rosedale concept there.
Yeah, $75.
So you're doing like 150 a month when you're CapEx and repairs. So you're pulling 150 a month from cash flow, and then what percentage are you running for vacancy? Are you really doing like a 1 in 6 year, for the road?
Yes. Yeah. I mean, vacancy is how many months was it non-income producing divided by how frequently is it non-income producing. So, 2 to 3 months between the turnover and then just the program lease up time frame, 2 to 3 months divided by 6.5 years.
You are running off 6.5.
Yeah.
Then what are we missing? We're missing turnover costs.
Turnover costs. Yeah.
How would somebody factor that in if they're running off of?
That's the moment when you're tenant screening, when the world tells you how good you are at tenant screening, and which is one of the reasons that a home inspection of their previous residence. In the tenant screening process, if you made me choose between looking at their credit score, or their pay stubs, or their landlord reference, or going and walking through their current house right now, I'm taking the 30 seconds walking through the living room every day of the week, and because they're going to treat your house the way that they treat their house currently, they're not going to be a new, they're not a different person. And that shows up and then you end up paying for that decision on the turnover. You may not pay for it until the turnover, but then you have a 10 grand turnover, whereas the immaculate one can be $1,500.
So for somebody sitting here today, like a $7,500 every 6 years, if we're thinking 6-year tenancy duration, like something like that, and then break it down per year, per month.
Yeah,
something like that for calculation. Jack's wife, Jamie, much like Jack, is a wizard with the property management side. So those questions, you can fire those away because they have just an extensive experience in property management. And I remember meeting with, we paid Jamie for consulting, and my goodness, we rushed to put tenants in there to get the refi in to start making money, and we soon realized like that was the most important stage to slow down and qualify their income, their walkthrough. I feel like we can talk all day about selecting the right tenant, property management, but something we probably won't go through right now up here, but those questions are definitely on the table. Before I shift gears, did the Orioles win? Not something I ask every day.
Final 0-2. Yes, they won.
How many wins are we going to get this year?
At least the one.
That was it.
Do they bring their farm system into play this year, or are they going to hold them back a whole another year? Any guesses?
You're above my head.
All right. I thought you were big.
I just like going to the yard.
Yeah, I bet. All right, so we'll take a step back from the numbers and whatnot. Let's get back to the economy. Like, what is your prediction with like maybe an imminent recession and what that might mean for those sitting in this room? Somebody who's either newer to real estate or dabbling.
I mean, I'm not an economist. I think about this stuff a lot because interest rate movements and, it's just a big planning thing for us. But I'm concerned about what is hard to, what I'm struggling with is that this much of an interest rate increase over such a short period of time, and yet that didn't actually move the market yet, is weird, right? Like that's just not, that freaks me out.
You talk about prices.
Yeah, it hasn't
Prices.
affected prices, real estate prices, and yet we have low unemployment, like we were talking before. We have low unemployment, but I think low labor participation. I think that we have declining savings rates, and I just don't think how I guess this isn't a political statement, but the money that we've been giving out over the past 2.5 years to get everybody through COVID, like there's no free lunch. Like at the end of the day, someone's going to have to pay for that, and you're paying for it in inflation right now, but that's gotten out of control. And I wonder if the Fed is now increasing interest rates to the point where they're basically going to end up causing a recession, because their mandate is to maximize employment and maximize full employment and minimize inflation. And I feel like they're just like grabbing the America by the collar and just giving everyone a good shake by sending us into recession, because that will get everyone back to work and work out these supply chain issues, and then they'll drop interest rates back down so that the economy like gets back on a normal path. But American consumer behavior right now is not congruent with it. It's not like we have a healthy economy right now, and so we have runaway inflation that we need to like cool everything off. We have a bunch of people who aren't working, and and many by choice. And a good way to do that is to make everyone feel poor by putting us into a recession so that everyone goes back to work.
And we very well could be in a recession right now.
Yeah.
So how does that change your business model? Like we were talking about this, like that dilemma of pooling cash or parking cash on the sideline at this time when inflation's running rampant seems to be not the smartest decision. But then it's also, how do you prepare for what's next? So what are some of the things that you're considering right now to prepare for, what could be doomsday or maybe a soft landing?
Yeah, so I think that anytime that there is a disequilibrium in markets, there is an adjustment to equilibrium, and during that adjustment, there are winners and there are losers of that adjustment. Whatever that move is, there will be winners of that and losers of that. Winners and losers on those. And so the way we're thinking about it feels like a very risky environment right now. Let's not go chase any shiny objects. Let's stack a little bit of cash to the extent that we can and prepare for whatever the opportunities are, right? Like if there are situations of distress, when there is an adjustment, there are situations that are where people are becoming distressed. And then opportunities come from that because, whatever, the bank, you get a call from the bank because they're like, hey, we got this situation. This guy got over his skis and leverage, and now rents didn't go up as much as he thought they were going to go up. And so now we need someone to work this thing out. But you can't take that call if you're busy chasing shiny objects, or you've gotten yourself or you've got problems at home, right? Like, unless you're lean and mean when that phone rings and have cash, when that phone rings, you can't take advantage of those opportunities. So I'm kind of risk off. We've been kind of like de-risking as this. We were talking about this in December, and then the past 3 months have just been a holy crap, each week worse than the last. So where we're just like chopping off like all the shiny objects that we were working on, or like things we were dipping our toe into, we just turn it off, shut it down. Like, let's just get, lean and mean and tight, and we'll see what comes. I have no idea what it's going to look like. I have no clue, but there'll be something.
But to be clear, you're still buying. You're holding firm.
Yeah, that's the difficult part, right? Like, because you got to keep the team together, right? Like, I'm super proud. I've got at this point, 140 employees across 3 platforms, and I don't want to send anyone home. Like, everyone's like, I really like them. Everyone's really good, And so I need to strike that balance between keeping people busy so that you keep the team together, so that when a really interesting opportunity comes along, you can say, yeah, I can do that. Where do you need me tomorrow? And we can deploy resources. But if you disband the team, if you break up the band, it's hard to get them together for that reunion tour.
Would you be willing to break even on deals right now to keep the band together?
I mean, yes. I mean, I guess it hasn't
Not
come to that.
not to give you a loaded question. But.
Yeah, no, it hasn't come to that, but yes. I mean, in theory, platform preservation, there's value in having built a system, right? Built a platform. So like dismantling it is extremely expensive.
Yeah. And what's your outlook? We went through predictions, right? We've been, Jack has been wrong plenty of times. You're right more than I am.
Everyone should go buy stocks
because you're pulling. What do you see the next 24 months looking like from prices in the market for real estate? So we're sitting here thinking, whether we're a flipper, we're a wholesaler, right? We were talking about rentals being squeezed and whatnot. What do you think that like the everyday investor should be thinking? Again, the next 24 months.
Yeah, just my ruminations of this week. I think that we've got there's still a lot of supply constraint, and that is still the overwhelming factor in the real estate pricing right now. So we need to get terms back into the market before we see nominal price decreases, and that we haven't seen either of those yet. Yep. So I wonder, I think that we've got a little ways to go before I'm actually afraid of nominal price decreases. Yep. Subject to, if we have a recession, how bad is it? I think kind of like if I'm, my over under is that we do go into a recession, and that is very troubling for the second home market, the luxury market, and landlord and rental properties, like stuff that can't be flipped, product for which there is no retail bid. I think those are the three segments that are the most exposed. And then within those three segments, depending on the concentration of those segments geographically throughout the country, people will say that, the Tampa MSA fared, well, poorly, whatever, Lewis, Delaware might be, tough for Lewis, Delaware. But if you're in $300,000 Baltimore 695 corridor, I don't know, not freaking out that much about that segment because it's affordable, and it's still the most affordable of the options.
If you were brand new, knowing what you know, but you got this W-2 job, a middle class wage right now, and maybe you're sitting in this room and you're like, I want to get in real estate investing, and you know what you know now, what would you do? How would you start? Like, what would you do? Would you be?
Yeah, so I would start with acquisitions because it's a supply constrained environment. And so the most value in the pipeline right now is being added by the acquisitions guy. You got it, or girl. You get a good deal, you're kind of, you're calling the shots for how that deal is going to go down. Money's still relatively easy to get. Fix and flip rates haven't really been affected. We've seen 150 basis point increase in rates. We really haven't seen fix and flip lenders that much. They're getting pressure too, but they are not yet really passing it through. Flipper cost of capital hasn't changed. And I think that as supply issues work themselves out, on the contracting side, that will be relatively easier, though I think that is the second most important skill set. So I would focus on learning, on acquiring skill sets. Number one on my list would be acquisitions. Number two on my list would be construction, and estimating and project management. And just focus on those skill sets and get good at those two things before you buy. You can wholesale because you're just, kind of get constant market feedback as to whether you did a good job or not, as to whether you made any money or not. But I would focus on learning those two sets of skills first.
we're about to open up some questions for those online. Plug in your questions. I'll pick a few out, then we'll make sure we hit all of ours up here. So if you have questions, write them down or recite them in your head so you don't forget, because I'll drag out for next like 5 or 10 minutes, and then we'll get to everybody here. Before we get to questions, is there anything else you wanted to make sure you mentioned that we didn't cover? I mean, there's so much more. We didn't really talk too much about flipping. You guys do a ton of flips, wholesaling. You guys do a ton of wholesaling, lending. Do the fix and flips in the 30-year, which a lot of credit goes to Jack for those DSCR loans that we all take advantage of, because one of the early movers, and you guys have just really done a great job with those. So what... If you had to, come with a couple more things, what would it be?
Yeah, this is probably won't expect me to say this, but what I did this week was call up all my banking relationships that I hadn't talked to in the past 3 years, because I was like, dude, DSCR loans here, that is the bank killer. Like, I never have to talk to my local bank ever again. This is going to be amazing. And I get this stuff done a lot faster. Right now, DSCR rates are in the 6s. You can go to your local bank, and if you can get it done, it'll get done probably in the low 5s. Like, I think that's still achievable. So that's 100 basis points.
Would you rather have the 6 if it's a 30-year fix versus where is the defined line where you take the 5-year call of a community bank when you could lock in a 30-year fix for next year? Basis points.
Yeah, no, totally agree. I look at it, like, if you look at the treasury curve, I'm very analytical about it. So, like, if you look at the treasury curve, like, what's the 30-year treasury versus what's the 5-year treasury? And so I look at what is the spread that the lender is charging me above the treasury, the government, and whichever is lower is my first decision. Like, that's the better deal, with the overlay being how long am I going to be in the business? But I'm still pretty young, so I still have a very long-term view. So I would just look at which is a better deal, which right now the curve's flat to inverted. So the 5 years looking pretty cheap right now relative to the 30. And I also think that I love the idea of being locked into a 30-year deal if I'm getting a good rate. But if I'm buying houses at a 7 cap and borrowing money, or buying houses at a 6 cap and borrowing money at 6 1/4, I don't really want to be in that loan that long. Like, I feel like I'm borrowing right now at a point in time where the markets are out of whack. So I don't really want to be in that long. So the fact that you can go to a local bank right now and get a better rate and lower prepayment fees, I think it's relatively a better deal right now, frankly. And that's against the product that I sell. So but the offset to that being that, like, you can't freaking get them to the table though. Is the problem is if you can get them to show up.
And then we talked about the whole tax returns and stuff. A lot of people might not be able to.
Yeah, exactly. That was one of the things I love about the DSCR product. But right now, and what has happened over the past 2.5 years is because those requests have not been going into the local banks, they have not developed, they don't have an expertise for it. Like, as bad as they were 2.5 years ago, they're even worse today. So I'm really not looking forward to that, but I think it's true. Like, I think it's just, the right move right now.
So this makes sense. I had a few people message me like, man, Jack posted on the Maryland Investor Network like something like cryptic about yield curves that nobody really understood. Anybody else see that? What's brewing in his head right now? That's when I texted you. I was like, what are you talking about? Like, I know you're talking about something, but it's like way above our heads.
The inversion, right?
And the just the dramatic increase in rates over such a short period of time, that was the main thing. Like, this is a huge shift and the prices haven't changed. Like, your margins are getting squeezed and no one's talking about it.
Yeah, that was your way of saying it.
Your margins are being squeezed. You're getting poorer and no one's talking about it. I said on the comment
thing, like, I want to respond to get this growing because I know it's going to go well, but I don't know what to say right now. Cool. No, but see, I think what everybody's recognized, and especially me, is like your deep understanding, and I know we appreciate the context behind you research and then come tell us like what you're seeing. We appreciate that. So far, was this very helpful? Yeah. Yes. Can we give Jack a round of applause? Jenny, did you text me some of these? I'm gonna fire away
You want to
Fire away.
fire away? A couple questions here, then we'll get to everybody here. When you talk about the programs in Baltimore, what programs are you using to fill your tenants?
Oh yeah, Housing Authority of Baltimore City, which is, everyone calls them Section 8. The Housing Choice Voucher Program, which is what everyone just calls Section 8, is the biggest, like the most vouchers on the street. But then BRHP, Baltimore Regional Housing Partnership, also has a lot of vouchers. HOPWA is folks with HIV, homeless services. There's a lot of Dayspring, people with some like addiction recovery history. Like there's a lot of great programs that accomplishing like some really phenomenal like social goals as well. And we've worked with a lot of them for a very long time. There's probably, I don't know, there's probably 10. Those are probably the top 5.
And to be clear, unfortunately, you guys do not property manage for others, right?
We do not.
You do not.
Yeah.
And you do not place tenants for others.
We do not.
You do not. Okay. This is a question.
It's a hard enough business in and of itself. Yeah. We're happy if we can do it for just ours. Yeah. Anyone does property management? Third party property management? Yeah. Sweet.
This is a question I think a lot of us are thinking right now. So I want to ask it. Somebody went ahead and asked this question. So more or less, we're thinking about this. So they said, we just put an offer in on a small multifamily that's being sold more or less at market price with existing tenants, but rents are under market. Now we're concerned we're overpaying. How would you calculate the purchase price on that, given how you feel about the future trends? So basically, we have a property that was looking good. Now we feel like we're overpaying. Like, what adjustments? What should you be thinking, considering adjustments, especially something that's got tenants?
I know you don't know the answer why they think they're overpaying, but be curious as to why they think they're overpaying. Just as a driver. So one of the we were looking at a bunch of multifamily syndication deals at the end of last year because we thought it was going to be a good idea to do some of those investments. We didn't end up moving forward, but one of the things that we found is that there is a lot of aggressive assumptions going into GP LP syndication deals, going into syndication models right now, both in terms of discount to defining what market rent is, aggressive, like that could be aggressive. How quickly, even if you are currently at a discount to market, how quickly are you actually going to be able to turn those units over? Like, what is it? People saying that, like, hey, I've got 50 units and I'm currently $250 a month under market, and in the year one pro forma, they're saying I'm going to be marked to market. They're going to fully have marked to market, like, but they don't have like a budget for having vacated the entire building. So like, do your assumptions in the financial model jive with the practicalities of how to actually operating that building? We saw a lot of bad behavior, or sloppy modeling, I guess. And then rent growth assumptions. We saw a lot of very aggressive rent growth assumptions because we saw a lot of aggressive rent growth during COVID. I think nationally it was like 14% a year. So people got accustomed to putting 6, 8s, and 10s into their pro formas and then not blushing. When for the past 50 years it's been 2. But and I feel like we're at a reset point now. I just don't think we're going to see that kind of rent growth. The Fed's not going to let us, right? Like, they're going to shove rates up until that doesn't happen. So I wouldn't be factoring in any material rent growth above normal levels, 2-3%. And then the last thing was people layering on variable rate debt. Without an expectation for rent growth, or without an expectation for rate increases. And then this past 120 days happened. So kind of just check your pro forma on what you think your cost of borrowing actually is. Because if you're using a model that's even even a data point that's 90 days old, it is way off.
I'm gonna talk about what, if I think I'm hearing you correctly, what you're thinking and seeing for those who are flipping houses right now, buying rentals, wholesaling specifically. So those three. So I'm gonna go through those three and let me know if I'm saying this correctly. So I want to summarize. And this will be applicable to everybody. So for rents, as of right now, we have cost of capital has gone up, interest because due to interest rate increases. So we're seeing rental margins shrink, but yet prices haven't come down. So being very wary of that, pricing in the current interest rate into the pro formas, not knowing what the future brings, and remaining conservative on that front, not pushing the envelope. And then in the future, there should come a point where the prices will reflect, will go the opposite direction as interest rates are going up. So from a rental standpoint, that's essentially, if we were to summarize your thoughts, that's, would I say that's accurate?
Yeah.
All right. Flipping. So we all know what the market's like right now for flipping. Things are selling like hotcakes, still selling at more than you probably thought when we all bought it, a few months ago. In the upcoming future for those flipping houses, what do you think that landscape will be for them?
So yeah, I think a normalization of that market is not that big of a threat if you're not in that second home or luxury market. And so I think that is, it's not you're not going to get bailed out like people got bailed out, right? Like you could screw up and still make money as a flipper especially the past 2 years.
Oh, I know.
So and as a result, there are people who are doing flips right now who aren't actually good at it. They just
I know.
and they'll get shaken out, right? Like because if they don't get that top line increase, then they're just going to lose money on the flip, which I think is then ultimately good for the more experienced flipper, because this ties into where you're going next, because then the wholesale deal that they're buying will have a smaller audience because the landlord bid is depressed because they're like, my cost of capital is too high, I can't pay that number anymore. And the flipper who can't execute in the flipper who doesn't have the wind at their back, just like the competent flipper is gonna, there's fewer of them and they've got, I think, more conservative assumptions. They're not gonna say like, yeah, screw it, because the market may not, they don't feel that the market's gonna bail them out. So I think ultimately that leads to normalizing margins in the flipping market. But we're not, that's like what's gonna happen, right? Like it takes the market a while to adjust to that, and it's very choppy for that to happen. It doesn't happen in a nice smooth curve. But I think that's gonna be the trend.
Yeah, we first gotta wait for prices to come down and days of market to go up, and then we gotta wait for people buying then to get burned 6 months or however many months from then. So we're talking at least a year is the prediction,
right?
Before you see anything change from this current landscape. And then from wholesaling, it's just going to get, it's a little bit difficult right now if you got the landlords who are smart enough to recognize that rentals aren't as sexy for the prices that the wholesalers think they are because of the cost of capital. And then it's only going to get maybe more difficult for wholesalers maybe when eventually the flippers
I think
normalize themselves out, and you basically cut the fat of
absolutely
those flipping houses.
And I think that wholesalers should be more cognizant of the quality of the counterparty that they're transacting with, because it is going to be relatively harder to get money to fund a deal in that environment. This isn't like today. Right now, it's probably fine, but 6 months from now it may be harder, and so
for flippers to get capital to buy the wholesale deal.
Yeah, so if you've got a great deal under contract and then dude doesn't show up at the closing table and you burn your seller relationship and you just lost a big margin, maybe you should have taken a little bit less with somebody who you had a track record with.
Let me log.